Hi there, welcome to Kneppy Invest. It is that time of month where I do the state of the markets video. Recording this on April the 24th. It is a Sunday. Australian markets will be closed tomorrow on April 25th because it is Anzac Day. And we did see a fairly big down day on the American markets on the last trading day of last week. NASDAQ was almost down 3%. Even the S&P 500 and the Dow Jones were down big as well. So we don't know if that's going to translate to Australian markets on the Tuesday because we still have one trading day left in the American markets. But particularly the NASDAQ is looking much more bearish right now than it has been for a while. I'm talking about maybe a month or so. But when you compare that to the Australian market actually has been looking quite bullish. In fact, it almost got to an all-time high recently. In fact, almost a triple top possibility. So what I do in these videos is I have a look at different markets. So I have a look at the equity markets, Australian markets, the NASDAQ, S&P 500, maybe the Russell, depending on what I'm thinking about on the day. I'm also going to have a look at the bond market, also have a look at gold, oil, maybe even iron ore, or some commodities anyway. And we are in interesting times right now. So I was very bullish during most of 2021, but my bullishness has become either negative or neutral since the start of this calendar year, particularly on the American markets. The Australian markets, much more neutral and a little bit more bullish. And the reason behind that is the Australian markets are focused on banks and miners, and they're not going to be really influenced by significant changes in interest rates. Those markets or those sectors that are highly influenced by tech sectors, particularly the NASDAQ, will be highly influenced by rising interest rates. So, in my opinion, the war in Ukraine will have no impact on any markets, particularly Australian and American markets, unless it gets worse and maybe evolves into something bigger. It's all about interest rates and inflation moving forward. And one of the best ways to gauge how or what might be happening in the future is actually to have a look at the bond markets, because their time frame is decades, multi-decades. When you compare that to the time frame of the equity market, we're only looking at 6 months to 1 year. That's their time frame of them looking forward. But the bond market is looking many years down the road. And you can get a sort of a gauge on how or what the market or the economies around the world might be doing over the next few years just by looking at the bond yields on different timeframes, 2 years, 10 years, 30 years. In fact, when the yields invert, that is a sign that the bond market is getting a little bit nervous about the future. You might be hearing how every single time the bond yields invert, you get a high likelihood, maybe even 100% chance of a recession within the next 2 years. And the bond yields briefly inverted a few weeks ago. So that does not necessarily mean there will be a recession, but the strike rate is pretty high there. And the reason why the bond yields didn't invert is simply because the bond market is nervous about what the economy is going to be doing in the United States in a few years. And the reason they're nervous is because of rising interest rates will put a lid on the economy's growth. And it's really funny because usually reserve banks will start to increase interest rates when the economy is going really strongly. That's not really happening. The reason they are rising or raising interest rates is because of inflation. And that's the other really big, interesting thing that's going on in the world right now is inflation, and whether that was transitory or something structural. So a few months ago, maybe 6 months ago, it was all about it only being transitory. And there are now questions about whether inflation is transitory. The thing I'm keeping an eye on is the labor markets. Now, we're getting to the point, and I thought this was not going to happen for a decade or two. We're getting to the point where there's not enough people being born. So those who are leaving the markets, those boomers leaving the markets, there's not enough people to take their positions. So there is a possibility, a strong possibility, there's going to be shortages in the labor market, particularly if companies don't increase their immigration. And if we have shortages in the labor market, that will push up wage prices. And that will be a structural, significant impact or have a structural significant impact on inflation moving forward. And so last time we really saw that was in the 70s and early 80s. So I'm going to do something a little bit different in this video. And instead of starting off looking at the actual, I'm going to actually start off looking at the bond market, because I think that is probably the most interesting market right now, particularly because the bond market has been in a 40-year bull market, one of the longest, strongest bull markets on record. Some have called the bond market as the greatest bull market of all time. And this is the monthly US 10-year government bond yields going back to 1982. And we have this chart going from the top left to the bottom right. So the top left there is at 15% yields, and the bottom right is toward zero. So you might be asking, how is this the greatest bull market of all time when it's going from the top left to the bottom right? Don't forget, bond yields are inversely related to bond prices. So if bond yields are going down, bond prices are going up. So inverse to that, if bond yields start to rise, bond prices should start to fall. And in the next slide, I'll show you the bond ETF TLT. And you'll see that has been going up over the past 20 years, which is different than what we see in this chart. One of the main interesting things about this particular chart is whenever we see a bit of a run in the bond yields or bond prices going down, that coincides with a significant decrease in the market or something seriously going wrong with the market. For instance, back in 1993, after the bond yields went for a run, we saw the NASDAQ correct 16%. Back in 2000, we saw the bond yields get towards a 100-month moving average, just like it did during 1993, and that was the tech bubble burst. Same thing happened with the GFC. The bond yields got to the 100-month moving average after a little bit of a run, and then we saw a major correction in the market. And then towards the end of 2018, that's when last time we saw the threat of interest rates rising, the bond yields were going up, and then we saw the NASDAQ correct 17%. And then all of a sudden, bond yields fell off a cliff, and that was the beginning of a significant run in the NASDAQ. And right now, we are seeing another significant run in the bond yields. In fact, over the past few months, the bond yields are really going up at a rapid rate. And right now, the bond yields, the US 10-year bond yields, is at a similar rate than what we saw towards the end of 2018. So this just increases the possibility of a significant correction in the market. We already see a fair bit of weakness in the NASDAQ. And the reason I'm talking about the NASDAQ is the NASDAQ and companies within the NASDAQ are going to be highly influenced by rising interest rates because most of their profits are way into the future. Those are the sort of companies you don't want to be owning in a higher interest rate environment, interest rates increasing at that. So the main thing to take away from this is whenever you see bond yields or interest rates rising, that is bad for the overall markets. And usually that leads to significant problems in the economy, and then interest rates start to fall. The problem with interest rates getting to about zero or just above zero is the major weapon reserve banks have or central banks have is taken away from them. So the ability to lower interest rates when economies are weak is a significant weapon. And with really low interest rates, that means that weapon is taken away from the reserve banks, and they won't be able to lower interest rates all that often or that much unless we see a significant rise in those interest rates over the next few years. So that's something to keep in mind, that the ability to lower interest rates is a major weapon we have to prop up the economy, to stimulate the economy. And if we don't have that major weapon, it then falls on the governments to stimulate the economy. And that's what we have seen over the past few years. We've needed the governments around the world to stimulate the economies. So, in fact, we do need high interest rates for the simple fact that is a major weapon reserve banks have. And this is the bond ETF that goes back to 2002. So bond yields dropping, the bond ETF has been rising up until recently. And in fact, the bond ETF, the TLT, has fallen from $180 to about $120 over the past few years. In the past 2 months, it's really fallen off a cliff from 140 to 120. So again, just by looking at this chart, you can see this is a nice uptrend has been over the last 20 years, because this is bond prices, and during the same time period, bond yields have been falling. Again, bond prices and bond yields are inversely related. Now, on to the last bond chart I'm going to look at, and that's the Australian 10-year government bonds. And just like the American government bond yields, which have been rapidly rising, same is true for the Australian government bonds. In fact, right now they're at 3.1%. The last time the Australian government bonds, 10-year bonds, were this high was way back in 2015. So right now we're almost at a 70 high in the government bond yields. Now, I've talked enough about the bond markets, I think, but it's always important to have a look at what the bond market is telling us. And right now, the bond yields are going on a bit of a run. The fact that the bond yields have inverted for a very brief period of time a few weeks ago is an interesting thing as well. So I always take a look at what's happening in different markets, not only the equity markets, not only the commodity markets, but also the bond markets, because it can tell you a lot about what's happening right now and what might be happening in the future. So let's have a look at the XGO daily going back 1 month ago. And on March 18, last time I did the video, the XGO was at 7,294.4. I was fairly either neutral or slightly bearish when it came to the XGO at that point in time. I think the uptrend had definitely come to an end. The high in the XGO was reached back in August of last year at just above 7,600. So let's have a look to see what's happened in the past month. And it's actually been good news for the Australian market, because the XGO actually has almost reached an all-time high. So it's been a great market for the XGO, up to 7,473.3. And that's after a really big down day on the last trading day of the week. The XGO was down something like 1.5 cents. And on the Wednesday, the XGO almost got to the previous high we saw, which was just under 76.40 in August of last year. It does look like a potential triple top. So we have seen that area reached 3 times in the past, back in August. We also saw it reached towards late December. And both times we've seen, or 3 times we've seen the XGO reach that level, we have seen a bit of a sell-off. But a nice little bull run during most of April, or last part of March into start of April. We have seen the XGO rise from its low of 68.40, which was towards the end of January, up to 66.40. I did see some projections from some experts out there that the XGO or the Australian markets will get to 8,800. Not sure where they're getting that from. And the other thing to take into account here is, because our market is dominated by banks and miners, not tech companies, we won't be as affected by rising interest rates. In fact, you will see a lot of people say that banks are actually positively affected by rising interest rates, because their interest margins will increase. And there is also the possibility that a lot of commodities and miners will be benefited by rising interest rates as well. So we could actually have significant upside to our market compared to the American markets, simply because we're in miners and banks. And you can really see the difference between the Australian market and the American markets when you look at the NASDAQ. This is a lot more bearish than we see in the Australian markets. In fact, the Australian market is not bearish at all. We almost reached an all-time high only a few trading days ago. Same can't be said for the NASDAQ. In fact, this looks really bearish. So a pretty good resistance level at about 16,800, and that top was reached in November last year. There's also a really good support level at 13,000, which was formed in May of last year. 13,000 was reached twice at the start of this year, and the NASDAQ is heading towards that level again after 2 really big down days in a row. Wouldn't surprise to see a little bit of a bounce off 13,000, potential triple bottom. And then if the NASDAQ does fall through 13,000 on strength, that would be a really bearish move. So right now, I don't think it's time to go all in on the NASDAQ. A lot of these companies on the NASDAQ are down 70%, even more than that. But a lot of those companies are not profitable, burning through a lot of cash. They do have increasing revenue. But I think the market is asking all these companies that are not profitable, not producing any cash in their businesses, that you have to show us that you will be able to become profitable in the future. It's really important, because there's a possibility some of these companies won't be profitable for 10 years. And that's why rising interest rates is really bad for those companies. because the way you truly value a company, is you take the present value of all future cash flows. And in a higher interest rate environment, future cash flows are going to be discounted way more than a lower interest rate environment. So that's why tech companies, particularly unprofitable tech companies, are highly impacted by a rising interest rate environment. When we look at the S&P 500, which takes into account the NASDAQ and the New York Stock Exchange, not quite as bearish as the NASDAQ, but it is moving towards that bearishness area. And there is that really good support level at 4160, which formed again in June last year. And we saw that level reach twice at the start of this year. And we are moving, or the S&P 500 is moving towards that level. The moving averages did cross over a few months ago towards the start of this year. And both moving averages are still going down right now, particularly after those two big down days in the last two trading days of the week. It's going to be really interesting to see how the American markets open up on the Monday. Again, I wouldn't be surprised to see a bit of a bounce because of two big down days. But if we do see the S&P 500, just like the NASDAQ, fall through that support level, that would be a really bearish move. And the last American market I'm going to look at is the Russell 2000. So this one is almost pushing through the support level at about 1935. So it has reached that level 3 times in the past few months, and each time it reached that level, we did see a little bit of a bounce. So right now, the Russell 2000 is right on that support level. If we fall through that support level, just like the S&P 500 and NASDAQ, that will be a bearish move. So another bearish looking chart when it comes to the American market. So right now, I don't think it's really good to be in the majority of American companies simply because of what's happening on the charts. But there are some actually really good looking charts out there. In particular, Berkshire Hathaway looks really good, really bullish. Costco looks really good as well. So even though the overall markets look really bearish, there actually are some good looking charts when you look at some American companies. Now let's have a look at gold. And gold is in an uptrend, a nice looking uptrend that really developed about 1 year ago when the price of gold was around $1,680. And it has been trending up ever since then. And I portray that uptrend by that sloping upwards blue line. There's a really good support level at just below 1920. And we did see the gold price just hovering just above that 1920 for about 1 month. And then we saw it take off again. And over the past week, we have seen a little bit of weakness in gold prices. So about 2 months ago, we did see the gold price rally all the way to about 2070. And that was a resistance level because that was the old high we saw in July of 2020. And it really struggled to get above that. So a really natural resistance level, might say double top there as well. But good uptrend in the gold prices right now. We're hovering in between the resistance and the support level. I'd like to see the resistance level broken. That would be a bullish move. If we see the support level broken, that would be more of a bearish move, but not a complete bearish move because we're still in an uptrend right now. But I'll be paying close attention to the gold prices because I do have a few gold companies in my portfolio. Here's a nickel chart, and a couple of reasons why I wanted to look at nickel, say instead of lithium. I'm actually more bullish about nickel for the long term over lithium because there's too much hype in lithium right now. Some of the valuations of lithium companies are really, we'll say they're priced to perfection. And I think at some point in the future, because all these miners are heading towards the lithium space, we've seen this time and time in the past. Whenever you see an overabundance of miners moving into one area, eventually you're going to see an oversupply of that commodity. And that's when the commodity price starts to really tank. Nickel is going to be a highly sought after commodity in the EV explosion, just like lithium. But there's a lot less interest in this space apart from that massive boom in the nickel price we saw a couple of months ago. Whenever you see that sort of acceleration, sort of an exponential rise in any price of anything, that's not the time to get on board. Always wait for the pullback. And we saw the pullback with the nickel prices all the way to the moving averages. And as soon as it hit the moving average, the 50-day moving average, that was the time to get aboard the Nickel Express. So this point in time, I am looking at possibly investing in nickel companies. I haven't really found one that has piqued my interest just yet. When I compare that to the lithium, there are just so many lithium companies out there, particularly new lithium companies entering on the ASX, mining companies changing their focus from gold, copper to lithium. And that's always a sign that there's just too much hype in a certain area. So that's what I'm thinking with lithium. But I think the oversupply in lithium won't happen for a few years. So some of these companies could go on a run for another 2 years. But if it does, I think some of the valuations of these companies, these lithium companies, will be even more stretched than they are now. Now onto oil. And when you look at the oil chart, this goes back to February 2020. This is a really nice looking chart. This is a sort of chart you want to be an investor in. And oil has been an uptrend and has remained an uptrend for the past year. We did see a bit of a rally in the oil prices started this year. It got to about $130 a barrel. It has pulled back to a low of about $94 a barrel, but it hit the 50-day or 100-day moving average, and then we saw a little bit of a bounce. And right now, it's just above $100 a barrel. So at this point in time, the uptrend has not been broken. Still some positive sentiment around this space. I have no idea what's going to happen with the future of oil. So I'm not one of these people who think it's going to get to $200 or $300 a barrel. I'm not one of those people who think we're going to see the price of oil fall off a cliff from here back to say 60 or 70. I have heard some of those people around. I just follow the chart, see what the market is telling me. And right now, still an uptrend, still some positive sentiment around oil, and no reason to sell out any of your oil companies if you are owner of oil companies in your portfolio. That's all I have for this State of the Markets video, April edition. If you do have any questions about anything I talked about in today's video, I'd love to hear your opinion, your thoughts, or your questions. So leave it in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a great day. Bye.